Much, David.
All right. Well, the U.S. economy is not yet growing strongly enough to merit a tap on the brakes. But did the Fed make the right decision? Joining me now is John Lonski, Moody's chief economist, Benn Steil, counsel on foreign relations economist, and Liz Peek, the FiscalTimes.com columnist. John, first to you, a lot of people can't figure this out. Even people that have been supportive of the Fed, at least at the beginning of the financial crisis back in 2008, 2009, say there's no excuse for them not to. And even Janet Yellen said things are getting better. The unemployment rate is coming down nicely. We've got a good bit of growth going. So why have these emergency rates at zero?
That's because of global financial instability. That's what the Fed is very much concerned about. Remember 1998, we went through a similar process. In fact, the Fed cut rates in September,
but it didn't have
November,
zero interest rates to deal with it. It didn't have
zero. It's not going to do it again, obviously. But I think the Fed realizes inflation risks are very well contained. Inflation's going no place with a stronger dollar, with the fact that we have such a gross underutilization of global production capacity. The Fed can afford to wait.
But then aren't there other risks to zero interest besides high inflation?
Well, probably not right now, David. The stock market's pulled back a long way. I think we have to be less concerned about financial market fraud.
If I'm a retired person on fixed income, I'm concerned right now. Because I'm getting a lot less money every month because of zero interest rates.
Sure, but I think we'd all be a lot more concerned if the economy were weaker, if borrowing costs were higher, if it were more difficult for companies to get the sort of credit they need.
But Liz, at the same time, banks themselves, I mean, they make money by loaning money out. But you can't make money at 0% interest.
Yeah, clearly that's one sector that's very much hurt by this. My issue with this really is we have an empty toolbox. If at some point our economy begins to slow, perhaps in response to the global insecurity we're talking about, what do? We're not politically, there's no way we're going to have any kind of major fiscal stimulus anytime soon. And if interest rates are at zero, yes, Janet Yellen actually talked about negative interest rates.
That's where I was going, as a matter of fact. And that was the scariest thing, John Lonski, for me, is when she started mentioning that. Because you have zero interest rates, which means that if you put money in a bank, you have to pay the bank to take your money. Savers are getting hurt bad enough as it is. But if they actually get penalized for saving money,
I don't think it's going to happen.
We turn into a new kind of economy.
I think that's highly unlikely. If anything, the Fed...
They've been talking about it in the Fed, though. She admitted it today.
There would be such an uproar from so many Americans, small savers. What will you do with money market funds? My goodness,
they die.
Yeah, right.
Money market funds would die, would they not?
They would, but I say good riddance. I mean, I think money market funds are a big source of vulnerability for the economy. They're an artificial creation with really a government guarantee behind it.
But is saving money so bad? Should we be penalized for saving money, Liz?
Some people want the risk-free rate when they
Clearly not. I mean, it's a distortion. And I think that at the bottom line, this enormous program that's gone on for so long, the 3 quantitative easing efforts, this continual 0% interest rates, has had distorting effects. And I think everyone agrees with that. And the problem is now we're this is called a hawkish hold. That kind of tells you how screwed up this is. Basically, now we're in a period of continuing uncertainty where the markets are going to be guessing, come October, is this the time, et cetera. I think the Fed's uncertainty on this has created some of the instability that now they're reacting to in terms of market volatility.
I was not surprised that the market reacted so crazy today. Were you? I mean, because without any kind of specific guidance from the Federal Reserve Chairman, it's not surprising that the markets can't figure out where to go.
The important takeaway here is what's been driving the market over the past month is not what's going on with retail investors. It's these algorithms, program trading and whatnot. You saw that at work today. And when you look forward, I mean, as stated earlier, there really isn't much room for stimulus. Profitability is slowing down. If we look at business sales outside of energy, they're barely growing 1 or 2%. So there's a lot of downside risk out there, and there's really no strong reason for shares to move sharply higher, even if Fed funds stays at 0%.